Hi, everyone. I'm Matt Clark, research analyst with Money and Markets, here with your weekend edition of the Bull and the Bear podcast. Now, as is tradition on the weekends, I will be bringing in Money and Markets chief investment strategist Adam O'Dell and Greens and Fortunes co-editor Charles Sizemore here shortly. But I do want to make sure that you're checking out moneyandmarkets.com every day, because that is where we provide you safe, sound, smart, simple, profitable investment information for your portfolio. Charles, Adam, myself, our entire team work diligently and very hard each and every day of the week, Sunday to Saturday, all 7 days, to make sure that you are updated in what's new in the market and what you need to know to bolster your portfolio earnings. And you can sign up for our free daily e-letter. You can do that at moneymarkets.com, and you'll get that information delivered to your inbox for free. Now, I want to jump right into it. I usually kind of have a whole spiel where I talk about a wealth of other things we have going on, but I want to jump right into today's conversation because, if you remember, and most people do, and investors certainly do, that in March of 2020, the stock market was rattled by the COVID-19 pandemic. This is when we experienced one of the largest market drops that we've seen in recent memory. Infections for COVID infections reaching all-time high. Investors were selling off their investments like wildfire. Between March 4th and March 11th, the S&P 500 dropped 12%, and that put it into a bear market. And then on March 12th, the very next day, the index fell another 9.5%, its biggest one-day decline since 1987. The decline carried on through March before stocks started to rebound slightly in April. And then, of course, now we know where they're at today. But in the weeks that followed the crash, and really in very short order, one thing rose farther and faster than anything else, and that's gold. Between March 22nd and March 23rd, the price of June COMEX gold futures rose from about $1,500 to $1,660 an ounce. That's a 6% jump in one day. And with that kind of value, that's a very impressive jump. By August, gold had surpassed the $2,000 mark. And it just seemed to it had an indication it was going to keep going. But as you can see on our video, I'm showing you a chart here, that investors started to pull back out of their hedge positions in gold and got back into stocks. That pushed gold prices down to around $1,700. And it's trading at around $1,780 an ounce right now, those June COMEX futures at present. Now, recently gold prices hit a 7-week high mark, but the future is still very uncertain. And that's why today I want to bring in chief investment strategist Adam O'Dell, Greens and Fortunes co-editor Charles Sizemore, and I want to talk about the immediate past and the future of gold, because I think there's a lot of interest here, whether you're actually holding bullion in storage or maybe you're into gold-related stocks or things like that. But I want to jump right into it. And first off, Charles, welcome. Why did gold prices rise so fast in the middle of 2020?
Well, gold is that ultimate doom hedge. When you are worried that the bottom is falling out and the end of the world is coming, gold is always has been considered a safe haven there. Same with treasuries. Gold and treasuries, even though you might think of one being sort of an inflation hedge, the other being a deflation hedge, they're both crisis hedges. And so that's mostly what we saw. When the world was shutting down, everybody was scared. No one really knew what the virus was. All they knew was, oh my gosh, they're shutting all the businesses. What's happening here? This is zombie apocalypse. I don't know what's going to happen next. I'm going to buy some gold just in case. And it wasn't just gold futures or gold stocks. People wanted the physical. Like, they wanted the coins of the bars in their house. There was a massive, this kind of gets lost in the detail, but there was a huge premium for owning the physical. People were paying, I remember at one point, I had a guy tell me that he paid, I want to say it was almost double the quoted price in order to have it in his hands. That's insane. You shouldn't do that. That's overpaying for insurance, of course. But when people are scared, they do things like that. That's what happens. So the big pop we saw in gold was exactly that. People were scared to death, and they ran to something that they thought would have some sort of store of value. Apart from shotgun shells and canned goods, gold is kind of that crisis. It's third in line after shotgun shells and canned goods. It's third in line as that crisis hedge. So that's exactly what we saw last year.
Pallets of Spam and pallets of gold bars. Now, conversely, Adam, why did the price of gold start to fall off later in the year? If people are still, this was still at a point where coronavirus infections were still rising, infection, as far as vaccine was still very unclear, but yet, gold prices started to taper off, almost thinking that fear is gone away. But was that the case?
Yeah, I'll answer that question in a minute, but let me first back up and tell the first part of Charles's story. I mean, Charles talked about why gold rallied, from April onward, late March onward. But let me tell you why it sold off first, because we actually, in my home run profits options trading service, we had a gold position on through the entirety of the Corona crash. And it was very ironic in a very bad way. I put on a bullish gold stock position on February 18th, which was one day prior to the absolute top in stocks, February 19th. So it was really bad timing on that entry. So I had that gold stock position as well as a utilities sector position and a communications sector position. And all of those positions drew down about 90% in through the meat of March when everything was selling off. Correlations go to 1 during a crisis, everything was selling off. I was kind of surprised that the gold stocks were selling off because, as Charles mentioned, everybody flocks to gold and gold-backed investments during crises. But what was happening there was it was two things. One, it was just a panic-driven sell-off, so everything was getting sold, and then it was also a liquidity cascade, meaning that people were getting margin calls and they were having to sell good investments to fund margin calls and to recapitalize their books. So everything was getting sold off. It was like, throwing out the baby with the bathwater. So you saw things like treasuries and gold, everything was selling off. And that's a liquidity driven event. Those are always short term in nature, not longer term. So basically, the way I risk managed out of that crash was we cut our losses on all the positions except for gold. The only position I held, I told my subscribers to hold on, was that gold stock position. And we held on through the Corona crash. So we were down about 90% in that position. It was an options position, mind you. So we were down about 90% through March. But then by April 9th, the position was up 120%. And then by July, it was up almost 500%. So certainly gold sold off as a liquidity cascade happened in March, but then it just rallied back super strong, April through the summer, through about August or so. So now to your question, why did it kind of pull back since then? Well, you have to realize that these fear indicators kind of they proceed and they ease off sooner than the crisis is over. So if you look at the VIX, I actually called the top in the VIX. It was basically March 19th or so. I said, this is probably the top of the VIX. And even if the crisis continues, I had no idea that the crisis was going to last over a year, but I did think it was going to last longer than a few months. And I said, even if the crisis continue and things get worse with cases and deaths, this is the top of the VIX because everybody gets freaked out initially, and then they get used to the idea that we're dealing with this. So the VIX topped early. Gold stocks topped earlier than stocks. And basically by last summer of 2020, everyone was used to the idea that we're living with coronavirus, we're going to muddle through it, we're going to get through it somehow. And they started rotating into, tech stocks and all the, pretty much every sector of stock has benefited from the recovery. And they were less interested in buying gold as a hedge. So that's why it's pulled back. I do have charts, we'll show them later, but I do have a chart of gold showing that this is an ordinary pullback. And we do think another rally is going to get underway pretty soon.
That leads me to another question, and that is, Adam, why are we starting to see gold prices come back, even as traditional equity stocks are going up as well? I mean, doesn't that kind of seem to be counterintuitive, or is there something else at play?
You can't look at the correlation too distinctly. What you have to realize is that the gold market went through a bear market while stocks were still continuing to rally. So, precious metals topped in late summer of 2011. And then they pulled back into 2016. So that's a 4 to 5 year bear market. And then they kind of dragged along the bottom from 2016 through 2018. We didn't see a bullish breakout of gold from the bottom until 2019. So you're talking about an 8-year period of underperformance, secular, kind of like a longer term bear market. And that's, meanwhile, stocks were going up the whole time. So I think that, the breakout in 2019 was just the beginning of a longer term, 7 to 10 year bull market, secular bull market in precious metals. So I think that, that's going to happen in stages. So you get the first rally into late last year, classic pullback right now, and then we're going to get the next leg up, I think this year. So, it's just a matter of the fact that they're out of sync with stocks right now. And you have to look at the charts and the longer term trends rather than just simply the correlation with stocks and what they're doing right now.
Now, Charles, you had mentioned that, you knew a lot of people and I think we had all known people that were really actively looking for the physical gold, either the coins, the bars, bullion, whatever they could get their hands on during the coronavirus crash. But what most investors do is, instead of trying to buy the actual physical gold, is they invest in gold related stocks. So what does this price movement that we're seeing now mean for gold related stocks?
Well, let me back up a second. So kind of to piggyback on what Adam was saying, gold, well, really all commodities are subject to boom and bust cycles. When demand is high, production ramps up. Then what happens? Prices start to fall because you flood the market with new production. So then what happens? Because market prices are falling, miners don't invest in new mines. They don't expand existing mines. They scale back on production because it's not cost effective to do. It's not cost effective to keep pulling more gold out of the ground if prices are falling. So then what happens? Then prices start to rise again, and then they start mining again. Well, there's always a lag because you can't just flip a switch. Gold mining is not quite like Saudi Arabian oil. You can't just flip a switch and just massively increase the supply or massively decrease the supply. It's a process to get gold out of the ground, get it to market. So that boom and bust cycle, there's always that lag, and that's partly to play here. You asked me a question, and I actually don't remember what it was.
We're seeing this topsy-turvy movement in the price of actual gold. And while, it's okay, to want to try to buy the physical property, the actual gold, the bars, the bullion, a lot of investors turn to more gold-related stocks, miners,
sure,
things like that. So what is this price movement that we're seeing, more specifically, that we're seeing kind of maybe this bit of an uptrend slightly in the price of gold, or at least for COMEX futures? What does that price movement mean for gold-related stocks?
So when people buy gold, whether it's the physical or they buy a synthetic position in like an ETF or whatnot, when they want position in gold itself, usually their thinking is hedging, diversification, etc. Now, when you're buying the gold mining stocks, I should say, are really almost like a leveraged bet on the price of gold. So it's more speculative. So it's really a different mindset. If you're wanting to hedge, you're wanting diversification, you're wanting just something that doesn't move in sync with the market, you buy gold itself. If you're thinking, okay, because a lot of people are doing that, a lot of people are buying gold, the price of gold's likely to trend higher, I really want to speculate here and make some money, then you buy the gold miners, because if gold goes up, if gold doubles, well, gold miners might go up 5 to 10 times. They're really, if you really hit a bull market in gold miners, right, you may never have to work again. Now, they're volatile. They can crash too. It's not unusual for gold mining stocks to lose nearly all of their value. This can be a very volatile sector, so timing is really important here. But that's it. What does this mean for gold mining stocks? Well, if the bull market in gold continues, and I do agree with Adam here that I think we are at the early stages here of a multi-year bull market in gold prices, precious metals prices in general, then the gold mining stocks should really amplify that. Whatever gold does, gold mining stocks should do more.
Okay. Now I'm going to ask you both, and this is kind of the last question that I have in terms of kind of talking about gold. And I'll start with Adam. Look in your crystal ball for a second, and maybe this is a good opportunity for you to pull up a chart on gold itself. Where do you see the future of gold prices through, let's say, 2021?
Yeah, so let me put on my Swami hat here. First of all, funny you use that language. I'm a chartered market technician, a CMT, which is basically a technical analyst of stock prices. And I'm specifically disallowed from saying that I can see the future with any type of certainty like you just suggested. So if anything, we just do it if-then analysis and projections, but certainly they're not seeing the future. So good.
And in all fairness, anyone who says they can see the future in terms of the market is probably not being completely honest with you.
Absolutely. Humility is the name of the game here. But so I've just shared my screen. Hopefully you guys can see that. And if you're listening to the podcast, check us out on YouTube. It's Money and Markets, the Bull and the Bear podcast. So you can actually see the visuals. You can see our mugs each week, and we'll share some charts as well. But what I'm showing here is a longer term perspective on GLD, the most heavily traded SPDR Gold Trust ETF. And what you can see here is on the far left of the chart, it starts in mid-2006, and we had a bull run from 2006 to late 2011, as I mentioned earlier. And then this is the this white line here, this horizontal line, which on GLD is at about 125, 128 price. Market's just open. So what you see there is that's called the neckline of a bottoming pattern. So you can see that prices topped out in 2011. They fell in fits and starts down through a low in early 2016. And then after 2016, we started seeing the beginnings of a bullish uptrend, but really prices went sideways. I mean, prices never really deviated from 120 on GLD. You got a little bit of higher highs and a little bit of higher lows, but really you hadn't broken above this 125, 128 level until middle of 2019. So really, I mean, it was a thankless job to be a gold investor, to be invested in gold mining stocks for about 5 to 6 years. And to Charles's point about gold mining stocks being a leveraged bet on the price of physical gold, you know, one of the reasons that is if gold companies can figure out how to get lean during the bad years, when the product they sell is selling for dirt cheap prices, they have to cut costs and hold back CapEx investment, and they have to really pinch their pennies and make sure that they're running a lean. It requires discipline to be a gold mining company that comes out the other side of a 5 to 6 year bear market in the price of gold. But the spoils that go to those companies is that when the gold price increases by 1 or 2 or 3-fold, those lean companies have cut costs so low that almost all of the additional price of gold that they can sell at market goes to their profit margins. So you can see hugely expanding profit margins very quickly, and that's really why you can get the boom and bust effect in gold stocks. But back to this chart, you can see basically in summer of 2019, you had a bullish breakout of GLD above this 125 level, a bit of a pullback. Let me see if I can draw it here. Very short-term pullback at this point, kind of a consolidation pattern. And then we had a rally out of that consolidation pattern here. Now this spike here that you see is the Corona crash. Okay, so you can see it basically went vertical. It was very V-shaped. It went straight down and then straight back up. Had another little consolidation pattern and then a strong rally into August of last year. Now let me expand this chart a bit because I want to show you more of the pattern that we've been in recently. And this is why folks have not really been talking about gold recently, is the price of GLD has fallen from this peak in August of about 190, 192 down to a low of about 160. So that's not a huge pullback, but it's certainly, as everything else has been rallying, you know, gold has not been an interesting investment more recently. So this is the pattern right here that I'm talking about. This is a classic consolidation pattern. It's kind of like a downward sloping channel, a flag pattern. And you see that after rallies that have gone kind of too far, too fast. So you get the first rally, investors think, well, all right, at these prices, I'm not going to earn as much as I would have if I got in at the beginning of this rally. Maybe I'll wait for a pullback to get back in. So that's really what we've seen since August of 2020. So we're going on, 8 months or so of this pullback. It's been very orderly and not very volatile. So it's just kind of this orderly pullback. And now what we're starting to see more recently is higher lows and higher highs. That's telling me that the trend is starting to change from a downtrend pullback correction more into an uptrend, and we're looking at making a bullish breakout of this channel. So 170 on GLD is the price I'm looking for. If we can get a sustainable break above $170 on GLD, I think we'll be off to the races. My kind of near-term forecast for GLD is $235, which would be about a 40% gain above 170. I think that we can hit a portion of that, if not all of that, in 2021, again, assuming that we can make a break above 170. So these are the chart patterns I'm looking at. I would be really surprised if GLD fell back below 155. That would be kind of the stop loss level of this pattern. But I think that we're going to get over 170 pretty soon, and then it'll be off to the races.
Charles, your thoughts on the future of gold prices, at least maybe through 2021?
Well, while Adam cannot see the future, I, however, routinely journey into the desert and consume a hallucinogenic cactus that does allow me to divine the future.
Oh, Lord.
Yes. Anyway, no, I agree with Adam. I don't pretend to know exactly what happens with gold, but I'll say this. Why would you not want to have some as a hedge right now? The Federal Reserve has nearly doubled its balance sheet in the past year. And in fact, as I'm saying this, it may very well have surpassed that doubling mark. It's like right there at the edge. In a world in which the Fed is creating new money at really unprecedented levels, it only makes sense to have some hedges. So what does that mean for gold? I would say gold is likely to, at least the gold price at a bare minimum is likely to increase in line with the growth of the Fed's balance sheet, roughly. Yeah, it's not one for one, but roughly. And if you believe that gold should be in a solid uptrend for the next several years because of that, then owning gold mining stocks also makes sense. So I don't have a specific price target, but my view here is so long as the Fed's very accommodative, it doesn't make sense to not own gold.
And I don't see the Fed's position changing anytime soon.
Well, it's not. They flat out said it's not. Like they've said there's no change for at least the next year. And after that,
it goes longer than that.
After that, it's we'll see what we do. Like they have not said a year from now we're going to make radical changes. It's we're not making any changes for a year and then, well, we see. So remember, after the last crisis, 2008, the Fed was still, had its foot on the gas well into 2013. So you are talking about 7 years later, they're still, just full throttle there. So to me, it's gold. Who knows where it goes from here, but the sky is really the limit.
Great insights from both Adam O'Dell and Charles Sizemore. Appreciate you guys coming on the podcast. Make sure, and Adam kind of mentioned this as well, if you're listening to this as an audio podcast, do invite you to go check out our YouTube channel. Go to youtube.com. Make sure you search Money and Markets. You'll find us with the green bull and bear logo. Make sure you click that, hit subscribe. And you can also click the notification bell so you get notified each and every time we put out a new video. We're doing a lot of videos. We have a new video series, Ask Adam Anything. It's where I get the opportunity to sit down and ask Chief Investment Strategist Adam O'Dell anything. And I do mean just about anything. There's really not much that's off the table here, and it's all fueled by questions that you guys, that you submit. So, and you can do that by submitting them at feedback@moneymarkets.com. Also, Charles has his own video series now called Investing with Charles Sizemore. He gives you his take on various stocks. He is a dividend stock guy. So if you are looking for, I don't want to box you into that corner, Charles. I mean, I know you're much more than that. But I say that because, a lot of people are really looking for, income with their portfolio. And a great way to do that is to find strong, high-yielding dividend stocks. And Charles has a great take on that. He puts out a new video each and every week talking about what investments he thinks are good for you, or maybe some ones you should stay away from. Check all those out on our YouTube channel. Of course, don't forget the Marijuana Market Update, as well as this Bull and the Bear podcast. Leave us a review on any of these platforms. If you have a comment or question or anything, you can email us, the Bull and the Bear @moneymarkets.com, or leave a comment down below on our YouTube channel. We would love to address anything you'd like us to take a look at. And head over to moneymarkets.com, sign up for our free daily e-letter for your safe, sound, smart, simple, profitable investment information from myself, from Adam O'Dell, Charles Sizemore, and our entire team at Money Markets, all working very, very hard. So we'll have much more coming up. Go ahead, Adam.
One last thing. We would be remiss to say that to not say that in our Green Zone Fortunes monthly newsletter, which Charles and I run, we have 4 precious metals positions on right now. They all 4 are buys right now at the current price. So we've written a special report on precious metals. I've recorded a video, a special presentation on precious metals. So we will link to that. All 3 of us are quite bullish on gold and silver as well. So that's also in the report. So if you want access to that, click on that link, and because this is a high conviction trade for us. So.
Absolutely. And he's absolutely right. The 3 of us are all very bullish on precious metals, especially gold, silver, and so it's definitely worth reading. We'll try to leave you a link, or maybe put a little thing up top here so you can click and find out more information on Green Zone Fortunes that Charles and Adam work very, very hard on. And again, a lot of stuff in the pipeline. We've got a lot more coming up, so make sure you join us on YouTube or on your favorite podcast syndicator. Until next time, everyone, for Charles Sizemore and Adam O'Dell, I am research analyst Matt Clark, host of the Bull and Bear podcast. Until next time, everyone, safe trading.